Investing in Tesla turned $100 a month into hundreds of thousands, and it's not just shares of TSLA. Hey Bowtie Nation, Joseph Hogue here with a follow-up video based on your comments. In our recent video on investing in growth stocks as the fastest way to build a portfolio and live off your dividends, I heard over and over in the comments, yeah, but growth stocks like Tesla are just too darn expensive right now. For that, I've got the easiest investing strategy you will ever find, one that's perfect for those boom-bust growth stocks. I'll show you how investing $100 a month works so perfectly, how it doesn't matter if shares of Tesla are cheap or expensive right now. Stick around and I'll reveal the 5 growth stocks to buy that will turn this strategy into a mountain of cash. Now, Tesla has been one of the most volatile stocks in the market, surging double and triple digits just in the last 2 years, only to lose a third or more of its value. If you were one of the unlucky investors to invest at that peak price in 2021, you'd still be trying to make it back into the green. But even taking advantage of those big dips isn't easy for value investors out there. Even when the shares plunge, they still don't look cheap. Shares of Tesla fell to a multi-year low in January, but we're still trading for 27.7 times on a price-to-earnings basis. That was 56% more expensive than the average stock in the S&P 500. Our shares are up 142% since that low, but it's a roller coaster of stress, and the same story going back more than a decade. Get caught investing at the top and you're deep in the red for years. But if you can get in at the bottom and you're up double digits fast. That is why this strategy of investing regularly, even as low as $50 or $100 a month, is so powerful in these volatile growth stocks. You're going to turn timing the market into time in the market and guarantee you are going to get in at that low price. In fact, here's what that $100 a month in Tesla looks like over different time periods. Even in the turbulent last year, you could have turned 12 months of $100 into nearly $1,600. That is a 33% return. Invest over the last 5 years, and you would have grown your money more than 5-fold. And over the last 10 years, Tesla was a 10x stock, growing your $100 a month to $136,000. But the best part of this $100 a month strategy is, even if you had started investing at the very peak, November 2021, when the shares hit a post-pandemic summit of $381 each, you started investing $100 a month and immediately saw your portfolio crushed, with Tesla falling 49% in the next year. If you had continued to invest that $100 a month for the 21 months since, you would still have made money. Shares of Tesla are still down 30% from that 2021 peak, but your portfolio, after investing $100 a month for 21 months, would be up more than 14% because you were able to buy in at those bargain basement prices. This is the most liberating, most stress-reducing strategy you will ever find because it means you no longer have to worry if a stock is expensive or not. Scared about the 200% jump in Nvidia this year but still think it dominates that race for AI chips? No problem, invest every month. Worried that my favorite growth stock, SoFi Technologies, is getting ahead of itself after surging 108% from December's lows? No problem, invest each month. Whether these stocks are in a bubble or not is no longer a problem. Invest that $100 a month and you will make money. Now I'll show you those 5 growth stocks I'm buying next, stocks perfect for this strategy. But first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to see. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now in these 5 growth stocks I'm going to show you, I'm looking for companies changing the industry in which they compete. Companies that are dominating in a new way of doing business or a new type of product and are showing that through faster sales growth. That's the key to these growth stocks. They're growing sales much faster than competitors or the industry average. A clue that they have some kind of competitive advantage that is allowing them to take that market share. The first stock won't surprise anyone in the Bowtie Nation. Shares of SoFi Technologies, ticker SOFI, up 116% just in the last 3 months. I've been buying shares of SoFi regularly since April of last year, now with over 18,000 shares and a 76% return for 164,000 invested. That surge in the price though has taken the shares from just 0.8 times book value to 1.6 times book, well above the average for bank stocks around 1.2 times book value. And investors are worried that the stock could give back some of those hard-earned returns. But that growth that is taking it higher and dominating online banking is still there. The FinTech Super App added another 433,000 members in the first quarter alone, growth of 46% over the year to 5.6 million users. Revenue jumped 43% on a year-over-year basis, and the bank increased its deposits in a quarter that saw a banking crisis wipe out deposits for most small banks. Now, a lot of the recent upside has been just a build-up to the end of student loan forbearance. SoFi started as a student loan refinance platform and still has significant income from the segment, income that has been stagnant as people delayed repaying their loans. The upside goes beyond student loans, though, as SoFi develops into a full-service financial platform and one of the few fintechs with a banking charter. That means it can collect those cheaper deposits funding to use for its loans. And I'll admit, I've been worried about the current valuation myself, but this company is expected to double its revenue over the next 3 years. This is still a relatively small bank with just $10 billion in deposits. That makes it tiny even among regional banks and means massive growth ahead for what could be a major bank with hundreds of billions of deposits. That makes it the perfect stock for the steady $100 a month strategy. You start investing and get that return if the shares keep running, but also the chance to get a better price if the stock comes back down. Another favorite here in a growth industry, digital gaming leader DraftKings, ticker DKNG. You can see here, I've been buying DraftKings since October of last year with a 147% return and almost $55,000 in gains on 3,000 shares. DraftKings is live in just 17 states, representing a third of the US population. Not only does the company have a huge runway into states that have yet to legalize online sports betting, but still has expansion into those 6 additional states with legalized betting where it isn't yet present. In the states where the company competes, DraftKings dominates with 20 to 30% of the market, second only to FanDuel in most markets. With a total addressable U.S. market of $26 billion in sports betting and $48 billion in iGaming, that could take the company to nearly $10 billion in revenue from just $2.2 billion just over the last year. The company increased revenue 84% in the first quarter from the last year and launched sports betting in Ohio and Massachusetts. It's grown monthly players by 40% over the past year to 2.8 million, and what I really like here, the company increased its average revenue per player from $67 to $92 over the last year. Not only is it growing scale, but also getting more profitable, a fact that could leverage that potential 5x in revenue into 10x more in profits. But that surge in the stock price has taken it back to 5 times on a price-to-sales basis, double where it was last year, and this is still an unprofitable company. That means, like all the growth stocks on this list, that near term could be rough if the shares give up some of that return, but invest a little bit each month and you're going to ride that stock higher long term. Another hot stock as of late was shares of Rivian Automotive, ticker RIVN, up 86% just in the last month alone. I started buying Rivian this year in 2 of my retirement accounts and am up 65% for a gain of $17,000 on 1,900 shares. Shares dropped in February when management put out a conservative production outlook of just 50,000 cars for the year. That's even as the company doubled its production last year and told internal teams that 60,000 unit production was a target for the year. I reasoned in the March video that management was just playing that expectations game and would easily beat its outlook. That's the story that played out when the company easily beat its first quarter production numbers and the stock jumped as investors rushed back in. Rivian has also announced that its Max Pack battery variants will be available for the pickup and SUV models by this fall, increasing the range by 50 miles for each. The company is also, I believe, just on the cusp of that point where the production of per vehicle costs start coming down fast. That's the big hangup for these smaller EV makers, is getting those production costs down to increase the profitability and just stop burning through that cash. Rivian has also already proven it can ramp up its production and take a share of that growing EV market. As it becomes more profitable, you're going to see those shares take off just like Tesla did a few years ago. Electric vehicles are still under 10% of the US car market, but it's expected to quadruple that to 40% by 2035. That is a market of tens of millions of cars for EV makers, with even a fraction of that meaning tens of billions in sales. So think about this. If Rivian captures just a fraction of that market for 35% annual production growth, it could produce 500,000 cars by 2030. That's the same as Tesla sold in 2020 with revenue of $31 billion and would be 20 times Rivian's last year's sales. Even if shares come down off this recent rally, this could be a strong long-term growth pick. And this next one is tough because it hasn't yet taken off like the others, but I still like Teladoc Health, ticker TDOC. I started buying Teladoc in 2022 after it came down from those ridiculous post-pandemic prices, but I'm still at a loss on an average cost around $37 a share. And folks, that is what you have to be ready for in these growth stocks, even on this $100 a month strategy. It may take a while for the stock to prove that growth trajectory and get you back in the green. You need to have the confidence in your research and stick with them for the rebound. Teladoc is the global leader in virtual healthcare with a provider network that covers 76 million US patients and a billion member data points, from that traditional telehealth to remote monitoring and next-generation primary care. Now, growth has slowed to 9% annually, but it's still the undisputed leader in this area. In virtual healthcare, one of my favorite growth stories. We may never get back to the pandemic level use of virtual healthcare, but it is still an unstoppable trend that's going to benefit the company long term. More recently, the company expanded its provider program into weight management consultation, which should help boost it in the near-term growth while the virtual market develops. Here, the company is hoping that access to virtual appointments with doctors that can prescribe weight loss drugs is going to bring in more companies and people to the service. Now, right here, the stock is trading for a price of 1.6 times sales, and while 9% annual revenue growth may be disappointing compared to the years past, it's still solid growth. If management can jumpstart that to maybe 15% and the valuation return to 2.5 or 3 times sales, you've got a 200% plus return on your hands and a stock that can go even higher long term. And yes, even Tesla, ticker TSLA, can still be on your list of growth stocks to buy regularly. Now, I'm not sure I buy Cathie Wood's price target of $2,000 a share by 2027, a move that would be 743% just in 4 years. But there is no denying that the company's lock on that growing EV market. Even on a drop to 18% market share in 2026 from last year's 62% control of the market, it would still be millions more cars sold and billions in revenue. Growth in electric vehicles aside, it's the robo-taxi market that could bring the real growth to the shares, with ARK estimating a taxi service could represent nearly $450 billion in revenue and 67% of a $6 trillion market value for the company. So even with the shares looking expensive here at 11 times on a price-to-sales basis, if the company increases its revenue 11-fold to over $1 trillion in that estimate, this will still be a very good stock to own. Get your weekly market update free with the link in the description below, or click on the video to the right to see the absolute fastest way to live off your dividends, how to grow your portfolio and collect that cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.